Welcome to our latest explainer. We're here to break down complex topics into clear, actionable insights for you, the professional.
$10,000. That's what we're talking about. That's the potential value of the American Opportunity Tax Credit, the AOTC, for just one student over 4 years of college. It's easily one of the most valuable credits in the entire tax code. You bet it can. And today, we're not just scratching the surface. We are going deep. We're conducting a full-on technical audit, really digging into how a student's gap year can clash with the AOTC's complicated and, let's be honest, often misunderstood rules. Okay, let's get into it. We're going to break our audit down into 5 critical points. First, we'll hit the foundational rules, the actual law. Then we'll move into practical strategies and, most importantly, how you can defend your position when the IRS decides to take a closer look. All right, our first audit point is the bedrock of this whole issue. You see, the AOTC isn't governed by just one simple 4-year rule. Oh no, it's run by 2 totally independent limitations, and they each have their own ticking clock. The idea from Congress was to limit how many times you can claim it, while also making sure it's for a standard 4-year degree. A gap year throws these 2 clocks completely out of sync, and that's exactly where the problems begin. Getting the difference between the taxable year limit and the academic year limit is absolutely crucial. One is just a simple tally of tax returns filed with the credit. The other is all about the student's actual academic progress. A gap year hits each of these clocks differently, and that sets up a super common trap that even experienced pros can fall into. So let's look at the first clock. This is a hard and fast counter, straight out of Internal Revenue Code Section 25A. Every single time Form 8863 is filed for a student, a little counter ticks up in the IRS master file system. There's no gray area here. Now, a gap year can pause this clock, but, and this is a big but, only if you don't claim the AOTC for that student in that year. Now, this second limit from subsection C is a whole different ballgame. This isn't about how many times you've claimed the credit, it's about how far along the student is in their education, according to their school. Basically, it's there to stop people from claiming the AOTC for a 5th or 6th year of what's supposed to be a 4-year program. And since a gap year means 0 academic progress, it doesn't advance this clock at all, which keeps you in the clear under this rule. So, you get the timing of the clocks right, but that's only half the battle. The next huge question is who actually gets to claim the credit. And that all comes down to dependency status, something a gap year can completely turn on its head. For a parent to claim a child over 18 as a qualifying child, it all starts with this definition of student from IRC Section 152. Congress wanted a clear, objective test here, and the magic number is 5. 5 calendar months of full-time enrollment. And just so you know, they don't even have to be consecutive. And this is where it gets tricky, because the outcome is totally binary. You either meet the rule or you don't. Think about it. A student graduates high school in May. Well, they meet the 5-month rule for that year, January through May. They're a student. But if they take a gap year and don't go back to school until September of the next year, they've only got 4 months of enrollment, September, October, November, December. They fail the test. It's that black and white. So when that student fails the 5-month test, they're no longer a qualifying child. At that point, you have to pivot and see if they can be a qualifying relative. But this backup plan has a major catch, a very, very strict gross income limit. It's designed to make sure the person is truly a dependent, not supporting themselves. And here's that income cliff. For 2024 and 2025, it's hovering around $5,200. So if that gap year student who no longer counts as a student under the 5-month rule goes out and gets a part-time job and earns more than this, boom, they failed the qualifying relative test. They cannot be claimed as a dependent. End of story. Okay, this table lays it all out, so let's walk through it. Zero in on that second row. That's the classic scenario. In year 2, the student is only enrolled for 4 months, so they failed the student test. Then we look at their income. If they worked during their gap year and earned more than that $5,200, they are no longer a dependent. And just like that, the person who gets to claim the AOTC shifts from the parent to the student themselves. So let's say you've nailed down the dependency rules. You'd think you're in the clear, right? Wrong. You can still blow it because the timing of your tuition payments is absolutely critical, and getting this wrong is a common and very expensive mistake. This is the classic timing mismatch. Normally, tax rules say a credit is only allowed for an academic period that starts in the same year you made the payment. So it looks like the expense doesn't count in 2025 because the semester starts in 2026, and it doesn't count in 2026 because the payment was made in 2025. So is the credit just gone? Nope. The tax code actually gives us a way out, a specific safe harbor just for this situation. You'll find it right here in section 25A G4. This rule explicitly lets us treat a semester as starting in the year of payment, as long as that semester begins in the first 3 months of the next year. It's a targeted fix for this exact problem.
So the strategy is pretty simple. You tell your client to pay for that spring semester in December. Since that semester starts within those first 3 months of the next year, Section 25A G4 kicks in, and you can claim the AOTC on the tax return for the year the payment was made. This is how you can effectively claim an AOTC in what would otherwise be a zero expense gap year.
Okay, now let's go beyond just staying out of trouble. The AOTC is a finite resource. You only get to use it 4 times. So we should start thinking like asset managers. A gap year is the perfect time to get strategic.
Here's the key. You are never required to claim the AOTC. Let's say a student takes one little $500 course during their gap year. If you claim the AOTC, you get a tiny $500 credit, but you've just burned one of your only 4 tokens. The much smarter play, as you can see in scenario 2, is to maybe use the lifetime learning credit, which doesn't have a 4-year limit, or just skip a credit altogether. That way, you save that valuable AOTC claim for a future year when tuition is much higher.
And finally, let's bring this all home and look at the tax form itself, Form 8863, and the pretty severe consequences of getting this wrong. This is where the rubber really meets the road. When you sign a tax return that includes Form 8863, your answers to these questions are basically you swearing to the IRS that you've followed the rules. Line 23 is you confirming you've complied with the 4 taxable year rule. Line 25 is you confirming you've complied with the 4 academic year rule. And line 24 is where you confirm the student met the workload requirement, which ties right back to that prepaid expense strategy. And listen, the penalties here aren't just a slap on the wrist. The IRS has the power to ban you from claiming this credit entirely. We're talking a 2-year ban for reckless disregard of the rules and a whole 10-year ban for fraud. And claiming the credit a 5th time because of sloppy record-keeping around a gap year, that could easily be seen as reckless disregard.
So if you want to survive a potential audit, meticulous documentation is not optional. The 1098-T form is just the start. You need the actual account ledgers from the school to prove the date of payment for that prepaid strategy. You need official transcripts to prove the workload. And if dependency ever gets questioned, you'll need expense logs to back up your support test. Keep all of this for at least 7 years.
At the end of the day, a gap year is not a tax-neutral event. It throws a wrench into all the standard assumptions we make about education credits. But by really mastering the details, the dual clock system, the dependency shifts, the prepaid expense rule, you can turn what is a huge compliance minefield into a real opportunity for strategic tax planning for your clients.